Ladies and gentlemen of the crypto space, we're live on a Friday, March 28th at 12:47 p.m. We're a little late today, but we're also starting 3 minutes early. We'll see how much time we have and what we could cover. Now, this has been a very interesting week because for the last 3 weeks, we have pushed below the weekly 100 on the DXY. And maybe I should preface this type of conversation for newcomers why we look at the DXY so much. It's a general high level inspection of the dollar relative to other currencies. It's currently very isolated to the euro and the yen, but the euro and the yen are quite related to and carry effect on the rest of cross currency pairs. So looking at the DXY does give you a very high level inspection of what the hell is going on in currency markets with regard to relative dollar strength. So for the last 3 weeks, we have been below the 100 on the weekly, and this week is coming to a close in 6 hours, and we punched above it for a nice wick, as you can see if we zoom in a little bit. So, but we have pushed back below. It is lower than the open, thus the red candle. And it's not like it's a bearish engulfing. No, it doesn't have that extra oomph from a confluence perspective, albeit it is constructive given that it is a rejection of the 100 SMA on the weekly. And for the last 2 weeks, he didn't have a punch above. So this is our first retest of the 100 SMA on the weekly. So we look for the next 1, 2, 3 weeks for follow up to the downside. And my gut instinct says we're going to start to interact with the 200 SMA at some point. Now, for folks to understand where we were back in 2024 at this particular DXY level, markets were absolutely ripping. Ripping, ripping, ripping. Frankly, these two downward legs in the dollar account for our two relatively bullish periods in crypto in 2024. This was a very, very bullish period heading into the end of the year. And then Q4, we had a big rip to the upside. This was I was excited back in 24. This was the potential for the continuation or start of a more meaningful move across the crypto landscape, but maybe it's actually best that things waited until pretty much the start of Q2 2025. Particularly because change of administration, all the policy we've seen, especially the absolute relentless news about Treasury and what Bessent's been talking about with regard to stablecoins and all the OCC and the bank rules and the SEC and their rules. And it's just a relentless stream of news around the stablecoin narrative. And that's the only narrative that matters. Every other narrative is secondary. The biggest narrative in crypto markets is stablecoins, is dollars. And we literally have the United States government talking about stablecoins and dollars. Oh my God. It's literally the perfect confluence from a narrative standpoint. So now all we need is technical conditions that contribute confluence to capital flows into the crypto markets. So the crypto markets are emerging markets, thus they are more tightly correlated with an emerging market rally. An emerging market rally is inversely correlated to dollar strength. Thus comes to our primary talking point, stream after stream, being dollar depreciation as a forward looking indicator of outperformance in the crypto markets. Rejection here over the next month, 4 candles. Maybe we start to interact with the 200 SMA on the weekly, and then it takes another couple of weeks for a breach through. And if anything presents as what we're highlighting here in the circle, with regard to the 200 SMA, a nice breach below, a retest, and then you punch the lower low like a 102.95. So breach 101, retest 102.4, and then a lower low like a 101.4. That is exactly what we're looking for as the forward-looking indicator for shit to get weird in crypto markets. We thought we were going to get there in 2024, the end of 2024, at the end of September. We did not get there, and this is a long time in the making, ladies and gentlemen. We have been waiting a long time. The last time we've seen anything remotely well, obviously in September in 2024 we were close, but this is what happens. And you have to remember, either by actual experience or maybe by stories, of what the hell things were like in July of 2024. July, summer. That was quote unquote DeFi summer. And here's your two legs for the Bitcoin top in 2021. It was a double run up. And then you go back, obviously, to 16, 17, leading into January of 18, where the dollar started ripping to the upside, indicating the end of bullish emerging market conditions. We have been waiting for this potential interaction, and we were teased back in 2024. We didn't get it, but we've been waiting for this particular interaction since summer of 2020. That is the last time we were in a comparable position from a relative dollar valuation standpoint. Period. Period. Here's your high level crypto inspection. And the best part is, we're not even looking at crypto charts. And that's the signal through the noise. Social media folks, especially folks in 2024, they're looking at crypto charts. You don't even need to look at crypto charts to understand what's playing out in crypto or where crypto's heading. You need to look at the dollar and the volatility in the United States Treasury market, because the volatility in the United States Treasury market plays into the relative supply of dollars, thus the relative value of dollars, because that the supply of dollars plays into supply and demand balances, and that's how it correlates or affects the relative valuation of dollars. So we're seeing a little bit of strength in crypto markets, particularly because dollar supply has a tendency to increase under these conditions. With move coming down finally to 91, we go down to a daily. I don't want to go down to that shit. Let's go up. All right. So from a moving average standpoint and a volatility indicator, it's not too constructive, but interesting no less. When they have been unable to push below a 200 SMA on the monthly chart. So what we're looking for is solid downward movement in treasury market volatility. As this thing starts to collapse, that's going to allow the DXY or take pressure off the DXY's upward trajectory and allow it to further roll over. Now, this is obviously a conversation of leads and lags, and the move indicator is a leading indicator of dollar down, but dollar down is only loosely coupled to treasury market volatility because there's a whole lot of other factors that contribute knock-on effects to the dollar going up and down, particularly geopolitical complexities, trade imbalances, international taxation, quote unquote tariffs. So all these play an effect. And we're not here to say whether things are bad. We don't want to get political. We want to do an economic inspection of things. And generally speaking, my 2 cents is we're heading in a favorable economic direction. For whom? You could argue in some regards it's not favorable for overpriced pig shit US equities, but that's another story because I just labeled them overpriced pig shit. Now, we could easily see a significant rotation of capital from overpriced pig shit US equities into more value related stocks, more closely aligned with manufacturing, industrials, mining, refining, so on and so forth, which in my opinion would be a healing of economic conditions, a curing of malinvestment. And that could be argued as well for international emerging market investments. Things need capital, and capital flows from where it's poorly treated to where it's treated best. Now, obviously, if the S&P is going to produce like 6% year over year speculated gains, and something's freaking rallying in India or rallying in Brazil or some other country starts to present strong economic overtones, that could trigger a meaningful reallocation of capital from 6% speculated outperformance to 12%. And that changes the equation. Capital flows from underperformance to outperformance. So if you're trying to get 10% of the money and the S&P is not going to achieve that as a projection, or the Nasdaq's not going to achieve that as a projection, it's going to flow somewhere else. And that's more or less what we see in some regards. We do see weakness, but you can't take this as weakness. I mean, this is literally the same type of weakness we saw in 2023, which was barely a mean regression to the 10 SMA on the monthly. It'd be nice to see a mean regression to the 50 SMA on the monthly. That'd be a meaningful mean regression. 15,568. Mainstream media will be screaming in disbelief and be like, "Oh my God, everything, it's all over." But we literally saw that in 2022 as a 50 SMA mean regression. So what happens is all these narratives get overblown. These mean regressions are healthy. This is a particular ETF of a particular quantity of stocks and is not representative of like a Wilshire 5000 or Russell 2000, which is a more broad inspection of the health and relative monetization of the US equities markets. And the reality is the US equities markets have been decimated. Complete malinvestment, concentration of capital into overpriced pig shit, which has prevented meaningful monetization of companies and businesses that really warrant better valuations, considering a forward looking perspective on where shit should head with regard to repatriation of supply chain and domestic manufacturing capabilities, which is explicitly administration policy. Nothing interesting to take away here. This is just Bitcoin relative to crypto fintech. Ethereum continues to be frustrating. 1800. Bitcoin was up at 86, 87, 88, now down to 83. Meaningful volatility. Look at curve with a 15% down day. This thing was up at about 60 cents yesterday. It rallied 12.5, 13%, and now it's down 14.6%. You drive yourself nuts trying to think of things from a volatility perspective and a trading perspective. So that's a topic of conversation maybe for another day. We've obviously hashed over the concept of buy things as cheap as possible, focus on cash flow. Rule number one, own more assets. Rule number two, know when to stop buying assets. And rule number three, the most important, fuck you, pay me, is the qualification of assets. Anyway, that's my technical inspection. Now, obviously, signal through the noise, gold continues to rally. It's literally up at 3,084, which is absolutely insane. And it just appears to be going parabolic and vertical. Isn't that really the story? Gold has been and will likely continue to be a great destination of capital. Absolutely the case. But at some point, when the dollar starts to do what we expect it to do from a forward looking perspective, crypto will outperform by countless multiples. And I expect U.S. equities, particularly NASDAQ ETF and S&P ETF, two specific ETFs, to underperform, whereas other ETFs could likely outperform. And I expect maybe the Russell 2000 or the Wilshire 5000 to relatively outperform compared to the S&P or NASDAQ for a period of time, cyclically, just as malinvestment is cured and overconcentration of capital is cured and overpriced pig shit U.S. equities are cured of their disgusting expression of economic perversion. Eunice in the house, good day, Cap. Much a pleasure. Fugu, good afternoon from Europe. Much a pleasure, always, my friend. My teeny tiny brain can't handle your deep financial analysis, but fortunately, my deep financial analysis comes at you 3 times per week in such a way that this financial analysis can potentially be absorbed over time. So that's the nature of financial analyses, that if you encounter them time and time again, over and over again, things start to assimilate, things start to get absorbed, things start to make a little bit more sense over time. Do note, everybody, that this financial analysis is a manifestation of countless years of inspecting these markets and redefining a more simpler way of thinking about engaging with the most volatile market on the planet, the crypto space. The only way to survive and maintain sanity in these markets is to define rules of operation, adhere to those rules of operation, and those rules of operation are clearly not related directly to crypto price charts. We literally didn't really look at crypto price charts. And that's the point. That's completely the point because the crypto price charts are noise, where the signal is literally the dollar, bond market volatility, and gold. That's it. And that tells us everything we need to know about crypto markets. And all that matters from a crypto market perspective is that we put in higher lows from November of 2024. And we don't have to consider whatsoever all the bullshit that happened with meme coins or at the beginning of the year with Cosmos airdrops, because those are isolated internal redistributions of capital, concentrations of capital. So the takeaway that we need to understand for the crypto markets is the increasing dollar supply and the potential for further increasing dollar supply into the future. And for that, we look at DeFi Llama and we look at stablecoin supply, which is up and to the right, up and to the right. I mean, it was literally up and to the right. $233 billion. Absolutely wild to see. And if you look at it from a USDC and USDT perspective, you got $144 billion of that particular type of dollar and dollar liability and bank deposit, because that's what USDC is. 144 bill there, but cumulatively there's $234 billion. All right. So what happens when there's a trill? What happens when there's 5 trill? What does that mean? What is the implication of that on financial activity in crypto markets? And that is what we're here for. That is what I'm here for. And that is the story that I tell you that folks should really take as what they're here for too. That's what's exciting. So what particular valuations or what particular cash flows are going to outperform when there's a significant increase in stablecoin supply? So now you got to understand what are stablecoins and why would supply increase, and all of these are very interesting conversations which we've talked about. And literally, for the first time in history, you have the United States administration policy saying, we want to significantly increase stablecoin supply. So you're like, oh shit, the narrative is stablecoins. So what's going to benefit from increasing stablecoin supply? Buying curve at 38 cents again. Well, does that imply you sold at a value higher than 38 cents? I don't know, but these are types of uh, thoughts around capitalizing on volatility, and that has a whole host of considerations, and that really needs to be someone's interest. Do they want to do that? That's the type of active engagement in crypto markets that someone wants to do. I prefer a much more passive or at least less active engagement with crypto markets, and that helps me with my serenity. Y'all know about serenity, right? President accounted for Coal World. Always a pleasure. Peter P in the house. Eunice, how long do you think Curve will go up in this bull cap? Well, bull, bullback, pullback. Um, irrelevant. There's well, will go in this pullback is probably what you're saying. It's irrelevant. I acquired my position in good part years ago, and at 20 cents, I increased curve position 50%, and that was the last time I interacted with curve from a purchase perspective. That's it. Now that's me, and that's considering my portfolio's construction, my time and duration in markets, and that's clearly not from the perspective of someone just observing and hearing my stream for the first time, and they're like, I'm trying to figure out what to buy, trying to figure out my rules. Rule number one, own more assets. Okay, which assets? For me, I'm firmly in rule number two, know when to stop buying assets. I have a certain amount of capital in the cash position, I have a certain amount of investments, and the overall composition of the portfolio tells me rule number two is applicable to me. That doesn't mean rule number two is applicable to you. What you need to do is respect your own portfolio, define your own rules, and adhere to those rules. It's very possible that folks are not in rule number two and they're still engaging rule number one. Rule number three tells us what types of financial investments to consider. Cash flow, buy a salary. The old school pizza shop narrative. Have you been tracking resupply metrics at all? Now, my 2 cents on resupply metrics is going over to here. You see, this is me, and I'm like, I don't, it's noise. It's interesting because it's affecting what's important to me, which in particular is CRV USD supply, dollar supply. $104 million things seem to have flatlined a bit. Seems like the market is waiting on more of resupply to engage, particularly with regard to vote incentives and or other components of their protocol to further drive expansion of what's treated as collateral in their system, which is Frax and CRVUSD, um, which is fascinating because dollars are also collateral. Right? Stablecoins are property. So as much as I define them as cash, in a sense, there are conditions and protocols within the crypto markets that allow them to be collateralizable. So there's a whole host of gray area in crypto markets, which is probably the most fascinating characteristic of crypto markets. Collateralizing dollars, such a fascinating concept. So I'm just curious. I mean, look at these interest rates. They're very constructive from a lending standpoint. So conditions are certainly there for an increase in CRV USD supply. I just, there's nothing like serenity. That's me, and that's my opinion. That's how I approach these markets. What can I do? Can't do anything other than observe and understand directionality and understand knock-on effects and understand where the hell things are heading. So things are building a very strong foundation. We're at $100 million of CRV USD supply, and the dollar hasn't breached the 200 SMA to the downside yet. And we know the administration policy is to increase the capacity for the system to have more stable coins, to have more dollars. So this is literally where I want to be. So I have positioned myself perfectly from an investment standpoint in the market where I want to be. I can't do anything else. And the market will drive total net worth, and that is complete noise, total net worth, because the market defines it. I don't have a capacity to define it, and I certainly don't want to take an active interest in attempting to achieve an arbitrarily subjective total net worth. I'm going to let the market do that for me. And that's how I engage with these markets. I do not know stream protocol. I do not know. Leandro, good morning, Cap. Do you think it's possible we see a deflationary liquidity crisis this year given the percent of debt of global GDP? In which country? You see, this is why it gets complicated in financials. In which country? And basically, what's important to me is, does that lead to an increasing or decreasing dollar supply? Because a deflationary crisis implies a decreasing dollar supply, in which case everything suffers. But then you also have capital rotations. So if you have a decreasing dollar supply, but all of a sudden a particular emerging market has a 10% increase in currency supply, for that particular emerging market, it doesn't freaking matter because total currency supply is just a relative phenomena. And that's exactly what accounts for the behavior in crypto markets in 2024. A relatively concentrated amount of currency just reallocating to cyclical outperformance. But he didn't have a significant increase in currency supply across the board, across the crypto space, which is now what we're experiencing, which is the ultimate forward-looking indicator. So these are very high-level, broad statements that generally induce a lot of fear in individuals. Are we going to experience a deflationary liquidity crisis? Okay, in which country? In Britain? In India? Some other countries in Europe? Germany? Asia? South Pacific? Australia? South America? Brazil? I mean, have you seen Canada? It's literally a disaster up in Canada with regard to the financial conditions as perceived by small businesses, housing prices. It's literally an economic catastrophe up there. So there's been a financial catastrophe in Canada, and certainly African countries have experienced deflationary liquidity crises. In fact, what was it, 2023? Great Britain experienced its gilt crisis, which was a failure. It would have cascaded. It was a banking crisis and, frankly, a national monetary crisis. And Britain decided to bail it out, which is very much akin to bailouts that we've done. We bailed out the United States banking system in 2023 also, because if we didn't bail them out with the BTFP, um, we would have had a complete cascade and a run on the banks. And that was in 2023. And then 2020 wasn't really what people think it was. It was really started in 2019, September 2019, with the repo crisis. The United States banking system failed in September of 2019, and it was bailed out, which led to the absolute across the board clusterfuck that occurred in 2020, which in some regards led to the United States banking system failing again in 2023, which led to the British economic monetary crisis. I believe that was 23 also. Y'all got to understand, the system has already failed, and it was bailed out multiple times, especially since September of 2019. And dare we inspect the shit that went down between 2008 and 2019? Failures everywhere, always deflationary crises and just all these complexities, liquidity cascades, currency destruction. It's happening all the time. So when we have fear of the concept of a deflationary crisis, it's more like you have the fear of an uncontrolled deflationary crisis, which means you need to understand the implications. In which country, and how does that country affect other countries? And all of these countries are markets, and markets have very simple principles, particularly capital flows from underperformance to outperformance. So a crash isn't a crash. I've said this story before. A crash is merely a redistribution of capital from something that's underperforming to something that's rapidly outperforming. So when you see NASDAQ go down 20% and 10-year yields completely collapse from 4% to half a percent, that's literally just a redistribution of capital from shit that's going down to shit that's going up. So that plays out also between markets of sovereign nations and between the emerging market of emerging markets, which we define as the crypto space. Hope that helps. I mean, even with lower short rates and QE, no one controls long rates. Private sector needs to be willing to borrow M2 to increase. Yeah, but these are all nuanced inspections, and it's mostly noise. Of course, the market controls the long end, but that's exactly why we inspect um, the move indicator, which tells us a forward-looking indicator on the capacity for the global economic system to increase dollar supply. Now, are you thinking in terms of solvency? Can the United States pay its financial obligations, its interest on its outstanding national debt? Right. Well, yes, they can. So now there's all the very well-known story of that they can always print the currency, which increases currency supply, and which means more people can afford goods and services, which drives up prices and is generally consumer price inflationary, depending on where that capital gets inserted into the system. It's just inserted into the banks and doesn't necessarily create deposits, which is a topic that George Gavin discusses quite well. It doesn't necessarily make its way into general public circulation, so you don't necessarily have an increase in consumer price inflation. It's isolated to banks, it's isolated to housing prices, it's isolated to property or equities, property being real estate. But very much all of these equations depend on where the capital ends up. So it's not as simple as like, oh, QE. QE is not as simple as what people think QE is. QE is just literally a bid in the treasury market to drive down yields. That's all it is. That's the whole concept of yield curve control as well, which is just the end state of QE. And I don't think we have an interest rate issue, especially at these current interest rates. The interest on the debt will continue to increase, placing an increased fiscal burden on the United States, which is a clusterfuck, obviously. But when that clusterfuck comes home to roost is another story. What measures are taken when there is a clusterfuck is also another story. And it doesn't mean anything right now with regard to the inspection that I prefer, which is if the dollar goes down, crypto gets monetized. What else am I supposed to think about? You never bet on the end of the world. If you're betting on the end of the world, you need a silo and a bunker and shotgun shells and 5 years, 10 years worth of green beans in cans. And that's your investment. So that's not something to bet on unless you're a prepper. So therefore, we invest in monetization and relative outperformance and capital flows and narratives about geopolitical policy. And in that regard, the narrative right now, stablecoins. So much stablecoins. Such an incredibly strong narrative right now. Hey man, do you have any position or thoughts on SUI? I do not. There's plenty of people that do. I just don't need exposure to it. If it does well, plenty of other things do well, and that for me would be an excess diversification. Critical mass curve has 50, 100 long down in the upper 30s, and so from a leverage perspective, fine. So there's big liquidation cascades, and people are throwing around leverage. I don't have any interest in taking part in risk reward calculations or forced accumulation of more by taking advantage of capital gains opportunities. I'm content. The hardest part of investing is being content with what you've been able to acquire and just following the rules. It's just not easy. There's a whole emotional game that people play with themselves, which plays a major factor in psychological stability. And to me, psychological stability means more than anything. If I am not cool, calm, and collected, I cannot make rational decisions, and therefore I cannot follow my rules. So I prioritize that above all. How do stablecoins help dollar remain world reserve currency? Most stablecoins are collateralized by United States Treasury instruments or debt instruments. Therefore, they're the ultimate euro dollar, meaning if someone wants to buy dollars and they're like, "Ooh, I could get my hands on stable coins," and the United States policy is, if you're going to print stable coins, you got to back them with T-bills. Oh, there you go. So if someone's paying dollars to buy stable coins, therefore the issuer of the stable coin needs to buy T-bills. Therefore, the person is indirectly buying T-bills. So the reason it's so popular in the administration is because it's a supply sink for the issued Treasury or United States debt instruments of varying duration. And by doing that, it allows the world to access dollar liabilities, which is what they do currently with international banks called Eurodollar banks, and what the United States could pretty much centralize to a degree if they can get the mechanics and the policy in place where the world could buy US debt and seamlessly convert them to functional dollar liabilities. Literally bypasses the concept of banking and makes the underwriting deterministic in many regards. And it's just literally a change of the equation with regard to the historic Eurodollar market. So, really, to understand how why administration policy is what it is you got to understand the nature of a euro dollar versus a dollar and what a dollar liability is, which is technically a euro dollar in the story of the euro dollar. So that is exactly why and how that is the case, Tate Pusher. Davey Bones, thoughts on Sonic? Yes. So as much as folks do mention other chains, Sui was mentioned, I do have an interest in Sonic because I was given exposure to Shadow vis-a-vis Arbitrum exposure by Ramses. That in hindsight, I'll give you my opinion after I take a look at my watch list and see what current pricing is. Damn. But still, 222. What's the market cap? 67. Significant depreciation, obviously, because emissions are significantly higher than current fees. So things aren't really balanced. We're in a relatively depreciating environment. Fully diluted value doesn't help, but that's mostly signal compared to outstanding market cap. But the exposure to shadow has been much appreciated. Revenues have been down over the last week, especially, but they've been basically down since launch. But suffice it to say, the fact that it is revenue and a relatively nice size amount of revenue compensated the overall composition of the kingdom, meaning if you had Ramses, you had like a Clio or a Nile, which was my case. The inclusion of shadow into that equation makes those four instruments like, so the market cap of shadow compensated for the demonetization of Clio and the demonetization of Nile and the demonetization of Ramses basically by itself. So it all balances out. And the revenue has been decent, even from a Nile perspective. So Linnaea is an interesting narrative. Like Clio has just been underperforming, Mantle has been underperforming, Arbitrum has been horribly underperforming, but Sonic has been doing well from a monetization standpoint. What does that mean? Cross-border flows into Sonic. Jesus Christ. Okay, so Sonic is a very interesting narrative. There's a massive delta in dollar supply, 32% week over week, coming in at $425 million. Is it? It's approaching optimism territory. But look at that. There's a significant decrease in stablecoin supply on Optimism. And you go over to Arbitrum, minus 10%. That was a massive. This is a hyper liquid coming online, and there was a very large capital rotation there. $3.23 billion. Let's see how Solana's doing. Pretty much level since the first bleed out in February. $12.249 billion, just massive amount of capital doing what on that chain? I have absolutely no idea. Avalanche looks decent. You know, the Avalanche narrative with, oh my God, what's the name of the V33? Shows you where my mind is today. I'm just a little fuzzy, but um, here. Faro. Faro's done quite well and has monetized significantly compared to its historic relative underperformance compared to its other kingdom peers. It's just kingdom narrative. Now, obviously, that's a downstream kingdom protocol, the core being Ramses, and Ramses is what afforded shadow exposure, and that was a meaningful thing. Probably one of the most interesting allocations. So while Ramses underperformed, it giving exposure to shadow means it was a great allocation of capital. Very happy with that and the way that played out. Hope that helps, David Bones. Good morning, Noah. Much pleasure. As soon, always good to see you. Tape pushers. So Europe can avoid a collapse by issuing euro. No, no, absolutely not. Why? So you got to understand what a euro dollar is. Britain owes debt to France. France owes debt to Portugal. So Portugal owes debt to Spain, and Spain owes debt to India, and India owes debt to Spain, all in dollars. So when you hear a country issuing dollar debt, what does that mean? It's like Canada, which recently made an announcement saying we're going to issue dollar debt. It means they're going to take a bunch of property, real estate, bonds, equity, securities, and say we want to issue $100 billion worth of dollar debt, and here's the bond. It's backed by this property, yada 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 yada. You're, how do you sell it? Someone's paying dollars for this Canadian dollar bond backed by this Canadian property. So that's how they raise dollars. But now Canada has to pay interest on that debt, on that bond. And that means they got to pay dollars. Now, this is the nature of the world. Everyone owes everyone dollar debt, which needs to pay interest in dollars. So they can't avoid shit because they can't print dollars, which means they need to be solvent from a dollar perspective. They need to pay interest on their dollar debts in dollars. So where do they get the dollars? That it presents the conundrum for the dollar construct on the planet right now. And that's why the dollar demand has a tendency to spike and rip up. Now, historically, what does the US do? They have this concept of swap lines. Whether that gets executed the same way or not is another story. Considering the change in the geopolitical situation, may not see the same swap lines, which is basically a bailout for a country that needs dollars, because if they didn't have that swap line, they would have to go to the open market. They went to the open market to buy dollars. There goes the DXY off to infinity and beyond, 120, 130, 140, 150. And then everyone has a problem paying their dollar debts. So that's basically the situation. Europe does not have any way to solve their dollar debt issues, and that applies the same for every country on the planet. Peter Farrow, yes, indeed, I appreciate that. As far as I know, the only thing investable in SUI is to be a validator, yeah, which invalidates it completely for me. And LPs, of course, which further invalidates it for me. Um, Resupply dropped their compensation for VE Prisma unlocks, which is nice to see. I got no idea how much this is worth. 1,767. RSIP's coming in at $2. I mean, at some point, the Prisma was worth $1, and I had 20,000 of them, so I was a 20 chip. So now this thing's worth what? 3,500? Yeah. So, but the damn market cap is a complexity from an ARPS perspective. So I don't know. Was I compensated adequately, fairly? I don't know. I'm not too greedy at all. So the fact that it's not worth zero is interesting and constructive. Um, I will be happy if I could get some cash flow out of it at some point. Obviously, the vesting is extremely slow. I'm not inclined to buy anything. Rule number 2 is engaged from me. Um, so what the hell would be the revenue on 15.15 RSUP that I could claim? It's literally $30. So this is not too interesting, which is why earlier, Arrow, you were asking about my interest in resupply. I'm much more interested in the effect of resupply on the outstanding CRV USD supply, because that affects me much more. Anyway, that pretty much sums it up. I guess I could go over the Voter Escrow Partnership a little bit. Let's put you back here. That's where you belong. So this document's come along very nicely. And I think it's reasonable. So obviously, I'll give you a quick little preface, folks. Any tax position is attackable, contentious. This is certainly has attackable components to it. But that's the whole point. Either you're in the driver's seat or you're not. Either you're expressing your interpretation of the rules as written, which is exactly what this document does, or you're just relying on an accountant, which is probably boring AF and just conservative and fearful. Or you ask your accountant to read a document like this, which has a more assertive position. Now, what does everyone always say? Oh, the tax law has nothing to do with DeFi. Yeah, okay, obviously, but what lawyers and what accountants have said, okay, here's the tax law. How can we apply this to DeFi? None of them. None of them have done it. All right, so I figured I'm going to do it. So, what I do is I take IRC code and I look at the language, I look at the rules, I look at court cases, and I cite quotes from court cases, direct quotes from judgments that substantiate an interpretation of the tax law as written. And I attempt to frame DeFi in a way that fits currently existing law. And I mean, that's the whole point. I mean, either you're just like, it's all income, 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 capital gains, capital gains. Okay, great. But that's not what DeFi is. DeFi is relatively sophisticated protocols that are not just producing income and capital gains. And that is the attempt of this document to frame what a lot of us do in voter escrow as a partnership. It literally fits the definition of partnership remarkably well. Um, here, no, did I give a good definition? So all of this is preface, and here's a good statement. Partners contribute tokens to the voter escrow partnership. Great. You buy your CRV, you lock it as VECRV. You're contributing tokens to a partnership, which is a shared engagement of activity. And you do that tax-free under IRC 721 with a partnership taking a carry-over basis under IRC 723. These contributions distinct from escrowed property received from third-party users, so it's important to distinguish between the amount of curve you put in versus the amount of accumulated what's called in DeFi transaction fees or vote rentals. That's something I actually have to address. That's a stronger argument in this document, vote rentals, as compared to DeFi transaction fees, but none of that matters because it's not fees. There's no engagement with a P2P person, a third party, and a business that the partnership offers. The business owns um, uh, independent entities, contracts that operate unto themselves. It's not like there's a storefront. It's not like there's uh, manufacturing or goods and services like a pizza shop. These are just analogies. So these are fixed entities, these contracts. So the escrow contract, that concept is basically when you claim CRVUSD, all that all that property, because the IRS treats all of crypto, quote unquote virtual currency as property under tax law. So all that property accumulates in an escrow contract. So what are the rules related to escrow contracts? What is the rules related to what's called nominee interest? And what is the actual economic reality when the partnership is you depositing curve as VE curve, but third-party users are engaging with contracts and the contracts are not interacting with that VE curve? The users, the third-party users are interacting with other third-party users. P2P, peer-to-peer, that's the whole point of DeFi. So they're not engaging with the partnership, they're interacting with each other, resulting in a portion of property that is escrowed. And when you frame this in terms of the actual text, the actual semantics and words of the law, it produces some very interesting effects that are quite distinct from concept of income and capital gains, because there's very specific rules to a partnership. There's very specific rules to nominee interest. So those are the types of things that I found quite interesting over the last weeks, months, and years at this point. This partnership analogy is not merely conceptual, but serves as the foundation of applying existing established tax principles to this novel decentralized structure, ensuring compliance and tax efficiency in the absence of specific IRS guidance and DeFi protocols. No, I'm changing this. I am not interested in IRS guidance. I am interested in congressional guidance. IRS is merely interpreting the words of Congress, and it is the words of Congress in a post-Loper Bright, it's a very important court case, which you probably heard of last year, maybe not, but anyway. It's congressional guidance that matters. Partners contribute resources, CRV to CRV-USD, VCRV, sorry. Participate in governance, great. Shared escrow property distributions within an ecosystem governed by immutable smart contracts that ensure transparency and enforceability. Transparency and enforceability. You can look on the blockchain, you can look at the smart contract code. You cannot deviate from the code. These contracts are going to do what they're going to do, whether a person wants them to do something else or not. And that means something. And that's very important with regard to the concept of dominion. Income is completely dependent on dominion. So if the partnership never takes dominion, meaning they have no capacity to invade a bank account, or the board or the partners have a capacity to say, all right, let's take this money and reinvest or do something like that, absent governance, then these rules apply as they are described in this document. Invade. If you cannot invade that escrow, You cannot just subjectively choose to do something with it. If you must follow the rules and it's an independent entity executing its rules as defined, great. It's a separate entity. And that's the whole point of contracts. Modularization. Each contract is responsible for its own thing, only responding to not even informational inputs, because the contract reads information from the voter escrow. It's like, all right, what's the relative, what's your VECRV voting power? It's reading that information. It's not like the voter escrow is inputting that information into the escrow contract for distribution purposes. So it's very subtle distinctions and very important considerations. Anything else? This came a long way in the last 2 days. So if anyone's interested, nobody reads this thing. Very few people. I mean, I apparently, based on a little bit of history of people that have read it, I might be the only person that actually reads it. But I mean, for the love of God, just either glance it over, throw it in AI, give it to an accountant, or give it to an attorney. I would think that this is kind of important stuff because, if you're claiming $500 of CRV USD and you give it to an accountant and it's like, all right, that's income, you probably want to read over this document because it's not income, it's property. It's not money, it's property. And in a partnership setting, an escrow distribution, then where the escrow contract has nominee interest, it carries over the basis because it's property, not money. The escrow contract is independent from the partnership. It's a discrete contract slash entity unto itself. So when the third party user engages with the protocol P2P with other third party users, that escrow capital, that escrowed property retains its basis. And because the nominee interest that is assigned to the escrow contract when it's claimed or delivered or distributed to the partner, you pressing a frickin' claim button, it has the same basis. So if $10 goes into the escrow contract and you're claiming $10, it has $10 basis. That means it's not income and it's not a capital gain. It's not income because in a partnership arrangement where you are a partner under IRC 702, the partnership is not taking dominion of the property in the escrow contract specifically because it has nominee interest. So if the partnership doesn't take dominion under Glenshaw Glass, which is a very classic case, with the quote being, here we have instances of undeniable accessions to wealth clearly realized over which the taxpayers have complete dominion. So in this instance, it's the partnership. But the partnership doesn't have dominion because it cannot invade or subjectively divert or do anything with the property that's accumulated in escrow. The only thing the escrow contract can do is read pro rata distribution rules from the voter escrow contract and distribute accordingly using its nominee interest. Anyway, that's the whole point here. And I cite court cases to substantiate positions and arguments and substantiate tax treatment. So the interesting thing is, it turns out IRC 731 is not applicable. So I was saying for a while that IRC 731 was applicable, which is basically a carryover in basis rules. But it turns out the escrow contracts are not part of the partnership. They're an independent entity. These contracts are independent unto themselves, separated, loosely coupled just by information either retrieval, and it's not information delivered. So as I said, the escrow contract reads information from the partnership, the voter escrow contract, to execute its predetermined distribution operations using its nominee interest. And that's the breakdown. The basis, this is very interesting stuff to read. And I don't think I have much more to enhance with regard to stuff like this. I do need to factor in vote rentals. But vote rentals are even further a stronger argument because the weakest argument here is the escrow contract part of the partnership? So we clearly can argue that these are discrete entities because these contracts are immutable. So are they or are they not part of the partnership? But when you're talking about vote rentals through vote market, that's a third party. That is an unambiguous third party. That's a separate protocol. So our partnership has nominee interest in those contracts, and those contracts do what they're going to do, separate entity unto themselves, and they deliver in the same way as the relatively more closely related escrow contract. It's a separate escrow contract with a separate protocol. So that is a much more stronger argument that all of this applies, especially to vote rentals. Um, I hope that helps. It's interesting stuff to me. It's a relatively concise document. This was a large document. At one point, I had 18 pages, but I had so much redundancy, lack of coherence of argument, and it was not ultimately as strong as it needed to be from an IRC code perspective. But this is the distillation of those original versions. Today's Friday. Go figure. I started this last Friday. So not bad for a week's worth of work. And obviously, I got all of this shit done with because I've been doing this stuff in other documents for some years at this point. Peter, thank you guys. Thank you for the kind words. I appreciate it. I hope it helps, folks. I want this favorable tax treatment using the laws as written by Congress. You know, Loper Bright was a big deal. And frankly, the Jarrett case, you guys should have heard of this on social media. So Jarrett was staking Tezos and received Tezos because he was staking and he paid taxes on them. But the IRS refunded his money. The IRS refunded his money and he didn't pay taxes on his staked Tezos. So there was no precedent set because the conclusion of the case it was dissolved. The case was dissolved because the IRS refunded their money, so the case couldn't proceed. But you can draw some implications. Why did they refund the money? I mean, obviously, a cost benefit analysis makes sense. If it's going to take the IRS $50,000 to try the case, and they were dealing with a $4,000 tax refund, they're like, all right, just give them the $4,000 and we say $50,000. So that's one interesting takeaway that you literally can consider a cost benefit analysis for how attackable a tax position is. And second is, I think they have legally shaky ground with regard to property rules because these instruments, these tokens are not money, they're property. And there's a lot of rules related to property. And that's exactly what this document does. It talks about escrowed property, not escrowed money, not fees, not interest. This is property, ladies and gentlemen. So it's a bit of a different ball game. Loper Bright was a big one because got rid of Chevron deference, if you remember that from last year. But there's been 4 cases that have used Loper Bright thus far, so substantiated, which is basically, all right, in a judicial setting, it's the words of Congress, the words in the IRC that matter, not, hey, IRS, what do you think? It's the words of Congress that matter. So, so I incorporate. I could bolster this because I have other documents that bolster the use of Jarrett, and obviously other documents that bolster the use of Loper Bright because it was. Oh yeah, actually I have it. So here's the 4 downstream cases that have used Loper Bright. So this is pretty strong reference. It's a strong precedent to say the words that Congress wrote mean everything, and the way you interpret it, whether it's you as an individual or the IRS as an agency, it's the words that matter. So it's the judge's ruling that matters. What do you say, Peter? I would take a look at this document. It is confluence with much of my own reading research. Nominee interest and voter escrow as a partnership is really interesting. I never thought to describe the relationship. And this document encapsulates all of that. And it's really that nominee interest that changes the framework and thinking of the contracts as discrete entities, that the escrow contracts, not what is the partnership? The partnership really is where the partners are engaging. So the partners are truly only engaging in the voter escrow contract. where they make governance decisions that produce basically information. And that's contained in the voter escrow contract. Everything else is downstream. And most of it's third party. Like when you're interacting with some of these contracts, it's an aggregator going to third party exchanges. And to top it all off, this is all peer to peer. So none of the users, the third party users, are engaging with the partnership. They're literally just interacting with one another vis a vis these pieces of software infrastructure. You followed Jarrett's case. Yeah, that was an interesting one. IRS didn't want to set precedents. Well, that was one of the two conclusions. Either they didn't want to set precedents because they're on legally shaky ground because of property rules, or it was a cost benefit analysis and they're like, all right, give them $4,000 versus spending 50 grand on potentially losing the case. So that was interesting stuff. Anyway, ladies and gentlemen, as always, I appreciate you taking a couple minutes to join me as I go on my ranting and raving. You know, this is basically like a regurgitation of stuff that goes on in my brain. But it helps keep me calm, cool, collected, and have a degree of serenity in my life because otherwise it's all internalized and it drives me nuts. So I thank you very much for listening to me. Friday, March 28th, 1:48 p.m. 190 people made it to the end of the stream, and you're all now a little bit more rational because of it. It's the weekend. Enjoy your weekend. Get into a sauna, walk, exercise, be happy, be healthy, let time pass. And I will see you guys and gals later next week for another story. Until then, peace.